I am Ryan Burke, and I am one of two assistant budget directors for the Department of Local Government Finance. So I actually began my career here back in 2011 as an intern. So I've been here about 13 years. And when I started, I knew nothing about local government finance. All I knew is that I wasn't graduated from college yet. I was a finance major, and this had finance in the title. So hey, sounds like a good department to do an intern for before my senior year. But I knew nothing about local government finance. Now, I've learned a lot in the past 13 years, and I will admit that I'm still learning more every single day. I never stop learning. But one thing I've noticed is that we get new local officials in every single year, and many of those local officials were in a similar place as me. They did not have a lot of local government experience, if any, either. So this is where kind of my passion comes in. I love to teach. I want to learn as much as I can because my process for the past 13 years hasn't exactly been fast or easy. I want to kind of digest the information to where it's easier and more efficient for others to learn. I want people to be able to get up to speed faster than I did. Now, when I was originally tasked with this presentation, I knew I would have to learn a lot about this process in order to put together a presentation that would be helpful with explaining the basics, along with leaving enough breadcrumbs. So this could essentially be a resource manual, or if you want to learn more about a specific type of lit, you have that Indiana code citation to go back to read more about it. But lit is an incredibly broad subject that affects every single county and state and generates billions of dollars in tax revenue every single year. And it is very important to have a basic understanding of lit to avoid being surprised by possible situations that can happen. There are definitely factors that can cause these lit amounts to change some years. And when you're reliant on this revenue to fund your governmental operations, to fund your expenditures, you need to be able to forecast this effectively. We have lots of reports, but sometimes when there's so much out there, it's hard to understand it all. So I'm really excited for the opportunity to give this webinar, give this presentation, and help explain what local income tax really is. But before we get started, I'm going to start off with a disclaimer. This presentation and other DLGF materials are not a substitute for law. This is not legal advice, this is not financial advice, this is just informative presentation, and the Indiana Code always governs. Now, like as I said before, lit is an incredibly broad topic that touches several different aspects. And if I try to give you all this at once, it'd be very, very overwhelming. I'm going to try to stop that as much as I can. In order to help introduce this topic, we're going to start by slowly peeling back 6 main layers. We're going to begin with the different definitions and terminology that we use for local income tax. Then we're going to talk about the players that we've got that are involved with lit one way or another. Now, these are local units of government, these are state agencies. Then, once we conclude with that, we're going to talk about all the different types of local income tax that we have. One very mysterious thing that we have is the adoption timing on if the county adopts a lit at this time or this time, when does it actually go into effect? When does it change the tax rate that taxpayers pay? We're going to try to demystify that quite a bit during this lit adoption timing. The lit supplemental distribution, I think, will be kind of a fun section because it seems like it's Christmas in May sometimes. This is sometimes referred to as the 13th distribution. But what this is when there are excess reserves, there is a supplemental distribution that is sent out to the units of government that have more than they need to in their state coffers, their state reserves for those counties' lit funds. So it seems like it's Christmas, kind of magical, but it really just comes down to math prescribed by statute. So I'm excited to be able to show you where some of those reports are and help you understand that calculation a bit more. Then we're going to conclude with some frequently asked questions that we get each year that will also kind of serve as a comprehensive check to make sure that we are kind of understanding the things we're going through with this presentation. And we should be able to answer most of these by the time we're done. So let's get started. So we're going to start off with the definition and the terminology. And we're going to start off with one question. What is local income tax? Now, This is a presentation all in itself, and this is just the introduction. There could be a whole series of these presentations dedicated to just local income tax. But what it is it is a county imposed tax that is applied to taxpayers' taxable income. Now, I don't really hear it this way ever, but another way that someone could technically refer to a local income tax as is it could be county income tax, because that's exactly what it is. Local just means the county, and it's county level. Now, local income tax is also often referred to as LIT. I'll refer to it as LIT several times in this presentation. But in addition to just being a tax that taxpayers pay on their income, it's also a pretty significant source of revenue for many local units of government. I would say for most local units of government, it's probably their second largest revenues. But units of government in 2024 are going to receive over $3.7 billion. That's billion with a B this year. And that doesn't include the supplemental distribution that would drive that number even higher. So it's a very important revenue. And admittedly, I don't think many people understand it. So pat yourself on the back for taking the time to watch this webinar, because I think it's going to be very helpful for you. Alrighty, so let's add the word rate here. What is a local income tax rate? A county's income tax rate represents the total of all the different categories of LIT with LIT rates that they have summed together. So each and every category of LIT has their own LIT rate. Now, the Department of Revenue, the people that do your withholdings at work, they probably don't see the individual breakdowns. They just see the grand total of all these. Now, this rate is applied to each taxpayer's wages over the course of the year. And withholdings are often taken out of each paycheck, but they may also be quarterly by self-employed taxpayers. So let's talk about what types of LIT rates there are. There are more than a few. There's quite a bit of these, but there are the certified shares, which are probably one of the more popular, more known revenues. There's public safety. There's economic development. There's correctional or rehabilitation facilities, also known as the jail LIT. There's the EMS LIT. There's judicial. There's acute care hospitals. And I will admit, I didn't really know what that was. So after spending a little bit of time on Google, it looks like that probably means urgent care hospitals. But this is a brand new LIT that will have effective July 1st of 2024. We also have the property tax relief LIT, the special purpose LIT, and in 11 counties across the state, we have levy freeze, which we'll talk about a little bit later. But once you add up the tax rate for all of these different categories of LIT, that's how you get the total county income tax rate. That's the rate that DORs will be concerned with. That's the rate that people that do withholdings will be concerned with. All right, so now let's talk about who receives local income tax payments. So this is where the state budget agency steps in, and they keep track of each county's separate amount of local income tax that are generated from their residents. They refer to these as their trust account. So each county has their own trust account. So only units of government within that county can receive the income tax distributions generated from that county. So if you are in one county, you're not going to receive somebody else's income taxes from another county. But not all units of government will receive a distribution. There are many units of government that don't have any property taxes at all, and many of those won't receive any LIT dollars. Now, there is an exception. I will admit, in the 13 years here, I don't think I've ever given a nice, straightforward answer without any caveats at all. Those days are long gone. And you'll notice lots of caveats throughout this presentation as well. So there's an exception that was passed a few years ago. And there are non-governmental fire departments, volunteer fire departments, and EMS entities that the county can kind of approve their request to receive part of the public safety LIT distribution. So that's a little caveat. We'll talk more about that later on. But generally speaking, you pay income taxes in that one county, and that is used to just to fund those units of government within that county. Right? Now let's talk about who pays local income tax. This one will get maybe getting a little bit dense, but then we'll summarize at the end and make sure that this makes sense in English. So income tax rates are adopted at a county level, and are paid by residents of that county. And there's an exception here. Again, always with the caveats. But the Indiana Department of Revenue issues this every year, and they have the Departmental Notice Number 1. Here's an excerpt from that notice. I'm going to read it, so bear with me. But both the county of residence and the county of principal business or employment of an individual are determined on January 1st of the calendar year in which that individual taxable year begins. If a person resides in Indiana County on January 1st or resides out of state on January 1st, but has his or her principal place of work or business in Indiana County as January 1st, he or she is subject to county tax at the rate corresponding to that Indiana County. Deep breath. All right, so let's translate that into English. So one of the better ways I've heard this described as is you take your tax dollars home with you. Now, unfortunately, you don't get to keep them. But for example, I live in Hamilton County, but I work in Marion County. So although I work in Marion County doesn't see any of my income tax dollars. That's based off where I reside on January 1st. I've not moved in forever, and probably won't. But because of that, because I lived in Hamilton County on January 1st, Hamilton County will receive my income tax dollars. I will pay the Hamilton County income tax rate. Now, there's another caveat out here is you will always pay the income tax rate for where you live unless you live outside the state of Indiana but work in Indiana. In that scenario, you will pay the Indiana County income tax rate for where you work. Alrighty. So that wraps up kind of the broad strokes, definition, terminology. And let's move on to the different local and state agencies, the players that are involved in this lit cycle. So when I was preparing this presentation, I was trying to make sure I didn't leave anybody off. I was able to come up with 8 different bodies, 8 different entities that have some sort of role in lit. So every single lit begins when it's adopted at the county level. This is where the local part of the local income tax comes into play. Local, in this case, just means county. The Department of Revenue, they post the county income tax rates for withholdings, then they collect the income tax revenue. The state budget agency accounts for each county's income tax collected separately, and then calculates the amount of each county's distributions, not at a unit level, but as a grand total for the county itself by lit category. Then the DLGF calculates those unit level breakdowns. So we take the SBA data, and we calculate the amount that each unit of government should receive. We use something called the attributed allocation or the allocation amount, but we'll talk more about that magic, those calculations later. Then from there, the comptroller's office is responsible for distributing the monthly lit amounts to each county. And then that's when the county auditor takes over and they distribute those monthly amounts to the units of government. That's when local units of government, they receive that revenue and they spend those lit dollars. That's where State Board of Accounts comes in, last but not least, to wrap up that process. And then they audit the local units of government for their record keeping and expenditures of lit. Make sure that complies with the statute and their accounting principles. All right, so let's get started on this first one, the county adopting body. So here's the code citation. I won't read all these code citations. There's several of these, many of these in this presentation, but I would highly recommend for anybody that wants to learn more about specifically what the statute says to use this presentation as a resource. So with this statute, this outlines the adopting body as either the county fiscal body or the local income tax council. So it used to be many years ago that there was COIT or COIT, which means county option income tax counties. And then on the other side, there were CAGIT counties, county adjusted gross income tax. So with those two different classifications of counties, things got to be kind of messy. The state decided to go ahead and combine all these into local income tax. However, remnants of CAGIT references, COIT or COIT references still remain. They still linger on. And here's the first case where we'll see where that makes a difference. Now later on, I'll teach you how to understand if your county is a CAGIT county or Coa County. But for now, we'll kind of talk about the difference here. So if your county is formerly a Cadgett County, it is the county council that is the adopting body. The county council will pass an ordinance to make changes to the configuration of lit in the county. Now, if you're formerly Coa County, then the adopting body is the local income tax council. This is the council made up of people from the county and each municipality, because they have opportunities to pass resolutions and vote on changes to the configuration of lit in the county. Now, I will say that the power of these votes are based off population. So this is where we get into kind of that unique scenario where there is a municipality with a supermajority, has over 50% of the population, and as a result of that, they have over 50% of the vote on lit dollars and the lit rates. Now, again, with the caveats, but this code citation includes additional caveats that outline specific configurations used to determine the adopting body and certain actions that can be taken by each body. All right, so let's shift gears and talk about the Department of Revenue, DOR. So they are responsible for informing taxpayers and employers of the newest county total lit rates and the process for paying income tax. The DOR then collects the lit dollars for the state. So within the income tax info and resources for taxpayers link here, you'll find a lot of links. One of those links is titled County Withholding Tax Rates. You click there, you'll get to what they call their departmental notice number 1. Now, this notice contains information about how to compute your state and local income tax, along with a chart of each county's county tax rate. So my wife is self-employed, and I remember many years ago trying to find these tax rates. That way we could file our quarterly payments for withholdings for the state. And this was very, very helpful because I was able to find Hamilton County, and there's the tax rate we need to be calculating with. So that's exactly what self-employed people, people that run these calculations for employers, this is where they get that information from. This is where they get the county's tax rate, the DOR, departmental notice number 1. So it's a very, very important document. I think it's well organized too. All right, so our next stop is the State Budget Agency. The State Budget Agency is responsible for reconciling and certifying the total amount of lit money by county and by lit type. These totals are then posted online, and then this report is distributed to the Comptroller's Office and the DLGF. Now, the certification process includes accounting for collections, refunds, amendments, adjustments, corrections, far more than I can even comprehend right now, but they do a lot of work to get these calculations done and posted online for us. So the State Budget Agency will post these lit estimates between August and October, and then by December, they will have the finalized upcoming year lit amounts. Now, on this link, the first link, the local income tax data, there's a list of all the lit calculations that were certified from 2024, dating all the way back to 2004. So 20 years worth of calculations. This is very, very valuable information for anybody that's interested. But let's take a look at 2024 as an example. So this has a row for every single county in the state, and you will see every single type of lit by category. So certified shares, public safety, economic development, jail lit, public property tax relief, all these different ones. And this report will detail the effective tax rate that is enacted here. Then on the far right, you get to the total. The total is what DOR would post and what people in charge of those withholdings would be most interested in. But because we're local government, we're more interested in these individual buckets, these individual categories. So these rates are helpful, but it'd be more helpful if they could post the amounts. And good news, they do. So this is where we can get into those county totals of certified shares, public safety, economic development, all those, which is super close to what we need, except being a local unit of government. You're probably less interested in the total amount that the county gets and more interested in how much you can get. So that's where the DLGF comes in. But before we do that, let's close things up with the state budget agency. So the 2024 certified totals are calculated based on the formula described in IC 6-3.6-9-4. And generally speaking, very generally, the lit dollars being distributed in 2024 are based off the process collections from July 1st of 22 through June 30th, 2023. Now, caveats galore here. The calculation above is a very much an oversimplification of the process to certify the 2024 figures. There are allowable adjustments outlined in statute, and estimates may be used if actuals are not available. So now that we've wrapped up that, let's move on to the DLGF and our role. This one I know a little bit more about for some reason, but we serve two main functions with respect to the lit calculation and distribution process. The first one is probably lesser known. If a county is wanting to change their income tax rate, they have the option to submit a pre-submission to us. This would typically include the notice that they would advertise, that kind of details the ordinance that they would adopt. And we would have 1 month, more or less, to issue a determination of appropriateness. So that doesn't mean that things are absolutely 100% right. It doesn't mean that we agree with it. It doesn't mean that we're giving financial advice or legal advice. It's just saying that for our limited purposes of what we would extract from there, that this meets the bare minimum level of appropriateness. Now, addition to that, counties that adopt those changes, we would be one of those agencies that receive your submission. Those are submitted through Gateway under the county unit. We'll talk more about that later. But the part that DLGF is probably really known for with the lit piece is that the calculation and distribution of the unit level reports are done by us. So when the state budget agency gives us those county totals by lit category, we break those out into individual unit level reports. So that is DLGF calculated data. And then we do the same with the supplemental distributions as well. So now let's shift gears and talk about the Comptroller's Office, formerly Auditor of State. So with the Comptroller's Office, they are responsible for making the monthly distributions to the County Auditor's Office for all except property tax replacement. This is just twice a year, but the rest are monthly. So distributions represent 1/12 of the state budget agency certified totals. That's what the Comptroller's Office will be giving the county monthly. Now the property tax replacement lit will be distributed in counties in time for the spring and fall property tax settlements. And the Comptroller's Office will distribute the supplemental distributions to the qualifying counties in May. All right, so now let's talk about what the county auditor does once they receive that. So county auditors have to do a lot here. It's very involved. They are in charge of the reconciliation of the monthly lit received from the Comptroller's Office against those DLGF reports. So they should be 1/12 of what the DLGF reports state. If that's not what you're finding when you're comparing these, please reach out, because we might need to dig a little deeper on it and figure out why that's the case. The county auditors are also required to make their monthly lit distributions. When applicable, they also make the supplemental lit distributions by the end of May. And then where applicable, if they're one of those 11 counties, they also make those monthly lit levy freeze distributions as well. Now, once the county has adopted a lit ordinance that changes the lit rates, those get submitted through Gateway's budget application. So you log into Gateway, click on budgets, click on the county, and this is where you'll see submit signed Form 4 and other documents. If you click there, there's a drop-down menu at the very top, and Form 4 is the first one, but on there you will see lit ordinance. So you would select that, add a description, and upload the file. That'll automatically generate an email to a lot of different state agencies. I'll receive it, DOR will receive it, state budget agency will receive it, a lot of us will receive it. But that is the only formal means of submitting your official lit changes to the DLGF and other agencies. And then auditors are also tasked with working with the treasurer to convert the property tax relief lit into property taxes for the June and December property tax settlement. That's because the property tax relief essentially buys down the property tax bills. And when the property taxes are distributed, there's no breakdown of the property tax relief and property taxes. The units just all see it as property taxes. You can't see my air quotes here. Alrighty. So now the units of government have received their monthly lit distributions where applicable. They've received their supplemental distribution in May when that applies. And they've also received their monthly lit 11-3 distributions if they're in one of those 11 counties. So let's talk about their responsibilities. You should be making sure that those amounts match those monthly reports. So let me rephrase. The amounts that you receive monthly matches a 12th of what those lit reports are stating from the DLGF. Now, there's only one case where it may not match, and that has to do with public safety, but we'll talk more about that shortly. So now let's move on to last but not least, the State Board of Accounts. They're responsible for developing a chart of accounts used by all unit types. They will also audit units to determine that the lit distributions were handled in a manner consistent with statute and their accounting principles. And they are also responsible for providing support to units with questions about receiving and utilizing their lit dollars. All right, that was a lot, but those are all the different players involved in that lit process. Now, let's shift gears a bit and talk about the lit configuration, all the different types of lit, the buckets, the categories. So let's get started. So when there is a local income tax rate, which there is for every single county in the state, they all fall into one of three buckets. There's the expenditure rate, which has more than a few different categories in here. There's the property tax relief, and then also the special purpose rate as well. So we're going to start dissecting these kind of piece by piece and help us understand what each of these mean and also how they're calculated as well. All right, so let's first take a look at certified shares. So here's the code citation that kind of dictates how we calculate certified shares. And this is where there's a caveat. Sure enough, if your county is a former CAGIT county, and again, I'll show you shortly on how to understand the difference of CAGIT or COIT, how to tell what your county is, the first 0.25% of the expenditure rate revenue will be distributed to all units, including schools, where applicable. Okay. The rest is then distributed to all units except schools as certified shares. But the allocation amount is a calculation that gives you a certain number, and we compare that to all the other units numbers to get your proportional allocation. So if your allocation amount is $1 million and the grand total of all of everybody in the county's allocation amount is 10 million, do the math, carry the 5, subtract pi, you would get 10% of the total revenue in this case. Okay, so it's just a proportional allocation. If your number is a certain percent of the total, that's going to be your percent of that total pie. All right, separately, so that one is only applied to CAGIT counties, where that first 0.25% is reserved for all units, including schools. Now, if you are a former COIT county, or you're a CAGIT county, and you have more than just 2.25%, that's where the attributed allocation amount comes into play. In all counties with adopted expenditure rates, certified shares are distributed to all units excluding schools where applicable. Now, the only difference between the allocation amount and the attributed allocation amount is that counties used to be able to raise property taxes for welfare expenses. That was taken away from them years and years ago before my time. And the story there is that they didn't want to be penalized for their ability to not raise property taxes for this. So whatever they raise for welfare, and I believe that last year possibly, they were able to have an adjustment to their lit calculation for that, as if they were still raising that same amount. So counties got to put their thumb on the scale just a little bit more to account for what they lost the ability to raise in property taxes for welfare. So long-winded, but the allocation amount and the attributed allocation amount are ways to finding out your percentage, your proportional allocation of the total amount for certified shares. So this is a lot. It's easy to lose people, but bear with me here a little bit. I think that this will make sense in the end. All right, so with the expense rate that we just mentioned, there are quite a few different tax rates. For each of these sections, I want to talk about that maximum rate that you can have. There's not a dedicated max rate for certified shares. However, there is a maximum rate of 0.25% for all counties, for all these added up, for all counties except Marion. Now, Marion is capped at 0.275%. All right, so you have to add up the certified shares, the economic development report, economic development, public safety, correctional rehabilitation or jail, EMS, judicial, and the acute care hospitals, which were effective July 1st, 2024. So that's not happened yet. Now, I did not know what the acute part of that meant. So I did a little research in Google, and the consensus is urgent care. So urgent care hospital lit is essentially what that translates into. But if you're in Marion County, all these added up together are capped at 2.75%. Else, you're capped at 2.5% for all these added together. All right, so let's take a look at the calculation of certified shares. So the state budget agency certifies the total amount of certified shares, but remember for casualty counties, you have to shave off that 0.25% that will be going to all units, including schools that are eligible. Then we have to subtract out lit levy freeze. And that's how we get the size of the pie for those proper certified shares, not including that school portion, or that portion that can go to schools as well. Now, with that being said, I mentioned lit levy freeze, but I've not really explained it. Let me take a quick tangent here. A select number of counties, 11 of them, had previously opted into freezing some of their property taxes at a certain level, then replacing their growth in their maximum levy with income taxes. All but one of those counties have, quote unquote, thawed to allow their property taxes to increase normally. And these counties have opted in to receiving some of their revenue through income taxes rather than from property taxes. So that's what this means. There's no opportunity for counties to become frozen again. There's a one-time deal that's gone now. But because they did freeze part of the revenue, freeze their property taxes at a certain amount, they still have this income tax to help fund what they gave up years ago. All right, so let's continue. This is where I think it's very important to understand. So if you only take away one slide for certified shares, it would be this one. Because a lot of people see that lit report, but they understand why this unit got more than me or this unit got less than me. And this is how we come up with the allocation amount and the attributed allocation amount. So I'm going to peek forward to the next one. This is the certified lit report. You can see there's two columns highlighted. One is just for schools, and the second one is the kind of proper certified shares. This first column uses the allocation amount. The second one uses the attributed allocation amount. So now let's time travel back a slide. All right, so to calculate this, it gets to be kind of tricky. So let's use an example. Let's say we're going to work on the calculation for the 2025 lit that's coming next year. So in order to use this, we use the current year the current year certified levy to the 2024 levy. So this does result in a 1-year lag between when the levies are certified and when those certified levies are used in the lit calculation. Okay. Now let's work through an example here. Let's say there's a brand new town established in Indiana in 2024. Doesn't happen very often, but definitely could. And they have a certified levy in 2025. So they adopt their budget in 24 for pay 25. So they start getting property taxes in 2025. They wouldn't begin receiving monthly distributions until January of 2026. That's because you have to use that certified levy from the current year as a starting point for the lit distributions in the following year. Okay, so there's a bit of delay here. All right, so it's the current year certified levy to calculate the next year's lit. However, I don't think somebody wanted people to be able to just take out new debt to bump up their certified levy and take more and more and more of the lit certified shares. I don't think that was what they wanted. So as a result, we have this adjustment. If you do have any debts issued after June 30th, 2005, there is a reduction to your certified levy based off that amount. So we do some math to see the certified levy attributed to that debt, or debts, plural, and we subtract that to kind of get the net amount, excluding debt after June 30th, 2005. Then there is a smaller adjustment, but we add in the certified shares for the prior year. So in this case, it would be the 2024s to calculate 2025s. And if there are no fire territories, that would be your allocation amount. Alrighty, but there are fire territories, and some people may not really understand what those are. But here's just an example. There's a couple of townships in town, they want to get together and provide fire protection. They're typically able to raise more property taxes, and that can sometimes cause a spike in tax rates. Now, if that happens, they will be increasing their size of the pie by quite a bit. And the way this works is, let's say you get 3 units of government together to form a fire territory. Only 1 unit is going to actually advertise and adopt and get a certified levy for those funds, even though the tax base is really all 3 units. So if we did not do this adjustment, whoever that provider unit is, the one kind of not in charge, but kind of in charge, the person doing the unit doing the advertising adoption, they would get a windfall of income taxes, while those other 2 participating units in the fire territory would not get any bump to their lit. And in order to avoid that, there is an adjustment. So there's a negative adjustment to the provider unit and a positive adjustment to this participating unit, so they can get credit for their portion of the fire territory levy. Okay, so that's how we come up with the allocation amount that we use for that first column that can go to all units, including schools. Now remember, that's only for formerly Cadgett counties. And the way this works, to use the same example as it did before, if your allocation amount is 1 million and the total for the county, all the units in the county is 10 million, that's where you get 10% of the certified shares, or the 10% of that total revenue for the county. All right. And again, the only difference between the allocation amount and the attributed allocation amount is the county gets a little bump extra for their welfare amount that they're no longer able to levy for. Now that amount does not change, it's static, but it is a little extra bump to the county. Alrighty. So let's take a look. Here we can see Brown County's 2024 certified local income tax distributions. On the top left, you can see some kind of odd code citation named distribution. And this is what used to be the property tax replacement credit. This is the part of the certified shares that aren't technically certified shares, but we still call them certified shares anyway. But that's the part of that can go to schools. It goes to all units that are eligible, including schools. All right, so you can see 1.1 million, 1.1. That matches the first column down below. Now, the proper certified shares, that $3.3 million amount, that is what we see in the second column. So remember, the first column is from the allocation amount. The second one uses the attributed allocation amount, which ignores schools and also gives the county a little bump in their percentage. Alrighty, we'll review this for each type that we have, and at the end there will be kind of a lump slide with all the different types of lit that don't really go to a specific unit or can't be allocated between different units. So one example is down below. We have the property tax relief rate of property tax relief of $2.2 million. That's where the other lit revenues will be. Alrighty. But this is where it's very, very important that you take a look at this third column. So the first one is the allocation amount, that code citation distribution. Then we have certified shares. And the third one, where the Brown County amount is $3,087,000. This is going to be your total certified shares amount. Again, technically it's not only certified shares, but when you're forecasting your revenues, when you're entering your revenue estimates in Gateway, you'll use R138 if you're a civil unit, and it'll be called certified shares. If you are a school, I believe the revenue code's 1130, and it's also certified shares. I don't think these are separated out separately in the revenue code list. But it's very important to make sure that you are reconciling these amounts, really a 1/12 of these amounts, against your monthly distributions. All right. So in this first one, you can see they're a Cadgett County. The second one, they're a Coet County. There is no amount in the first column that can be applied to schools. For economic development, here's the code citation. And this can be distributed, or this is distributed to counties and municipalities, cities and towns. And counties can opt to have the economic development distribution based off either the certified levy or based off population. If it's population, that's how it's done. If it's certified levy, it's not the attributed allocation amount, it's not the allocation amount, it's just the certified levy. So this will include all funds, including new debt after 2005. And you can see this highlight on this report. Now let's talk about public safety. Here's the code citation that you can always refer back to if you want to learn more about this. But the state budget agency issues the public safety total. And then we have to subtract that PSEP allocation, if there is any, off the top. That gives us that starting total for all the units of government. Now, one important thing to note is that counties have the option to reduce these public safety distributions further. So the DLGF report will be less. Will actually be overstated because the county can receive requests from the fire departments, volunteer fire departments, EMS, fire territories, and townships. They're allowed to request funding from public safety, and the county can choose to grant or deny those requests. But if they do choose to grant some of those public safety requests, that would be done kind of outside of the DLGF certification of lit. So this is the one case where 1/12 of these amounts may actually be overstating what you'll be receiving. Now, the calculation is based off this code citation, and for former Cadgett counties, we use the attributed allocation method, the one with a little bump for the county. And for Coet counties, it's just the straight certified levy method. It includes any debt, regardless of when it was certified. It's just the certified levy. So here's an example of where there is no PSAP distribution. That stands for Public Safety Access Personnel, but there's a public safety distribution. And here we can see it down there, allocated by unit of government. In this example, they have PSAP that's taken off the top. So we have 3.1 of public safety, 200,000 is reserved for PSAP, which goes to the county, and then 2.9 is for public safety itself. And here's an example in Hamilton County where they have the public safety access personnel, about $23 million, but there is no separate public safety distributions. So all goes to the county for public safety access personnel. And then there are a slew of other lit expenditure types as well. There is the jail lit, which is used by the county for only paying for correctional facilities and rehabilitation facilities in the county. Has a max rate of 0.2% or 0.3%. You can read that code citation to kind of go through the rabbit hole of, okay, if I had debt issued on this date, this amount or this, then it'd be one over the other. But there's the code citation for your reference if you're interested. There's the EMS rate, EMS lit, which is used by the county only for paying for operational costs incurred by the county for the EMS services that are provided throughout the county. This is a max rate of 0.2%. Then there's the judicial lit. This is used by the county for paying county staff expenses of the state judicial system in the county. That's max rate of 0.2. There's the code citation. And the acute care or urgent care hospitals. There's the code citation, and this will not be effective until July 1st of 2024. And this is used by the county for paying for operating expenses of an acute care hospital in the county. Has a max rate of 0.1. Alrighty. So property tax relief, this will buy down the property tax bill. And this is applied after or before surtbreaker credits. So this can actually increase the collections for the units of government. And this is received by the units of government as property taxes in their June and December settlement. There is no breakdown between these. But when this PTR, property tax relief amount, is adopted by the county has to allocate this to certain taxpayers. So this would go to all property types uniformly. It could go to just the 1% properties like the homesteads, the 2%, the 3%, or for all residential property, as specified in this code citation, and they can do it in any method that they want, as long as the total of all these add up to 100%. There's also a special purpose rate. There are 21 counties that have a special purpose rate that is available to them by virtue of statutes enacted under IC 6-3.6-7 that allows them to adopt a lit rate with a predefined reason, max rate, and duration. The special purpose rate cap is based off the statute for each specific county. All right, going good so far. The lit adoption timing. This is very kind of mysterious. Very few people in the state know this, so I will let you in on the secret. I want people to know. So this code citation identifies when the lit ordinances will go into effect based off when they are adopted. So if a rate change is adopted, a lit rate change is adopted between January and August of this year, the rate change on that DOR Departmental Notice number 1 that kind of directs those withholdings will change on October 1st of this year. If they wait until September 1st, but get this done by October 31st, that rate effective date will be January 1st of 2025. But if you miss that by a single day and you adopt it between November 1st of this year all the way to August 31st of next year, it wouldn't be effective until October 1st of 2025. So that single day makes a big difference. October 31st really is that cutoff to make sure that rate change is effective by January 1st of next year. Now, it's also possible for a county to just adopt a change in the distribution. If that happens before or by November 1st, the effective change date is January 1st, 2025. If they miss that by a day, it's November 2nd all the way through December, and that would not go into effect until January 1st of 2026. So that's the same as November 2nd of this year or November 1st of the following year has the same effective date change. So that one day is very important. Now, this code citation mentions that except for a tax rate that has an expiration date, a tax rate remains in effect until the effective date of an ordinance that increases, decreases, or rescinds the rate. So keep that in mind. Another thing is you only have one bite of the apple. You can only change this one time per year. So you have to make sure that this is exactly what you're intending. All right, now time for the fun stuff, the supplemental distribution. This will be a trip, this will be a ride, but we'll get through it, trust me. Okay, so the county qualification for the supplemental distribution is based on this code citation. I could read all this, but it'd be confusing, so I'm going to explain it instead. Let's start with the timeline. On May 1st, the state budget agency will provide the county totals for qualifying counties to the DLGF. That gives us 2 weeks to calculate those unit level breakdowns and post that report on our website. And then by the 31st, the county auditor will distribute those supplemental amounts to each unit that applies to that meets the criteria to receive this. Okay, this is done at a county level. So remember I said May 1st here, that's when the state budget agency will get these amounts to us. But if you're curious, this may not be finalized, but by February 15th, they do actually post a report that has this calculation done already. Again, I assume there might be some adjustments that could be made, so take that with a grain of salt. But if you want a sneak peek at what might be the final numbers, here's this report. It details the process collections for the prior year of lit, details the distribution for the current year, details the tax rates for the current year, and it calculates that excess balance that would trigger that supplemental distribution. So in this, it's 2 pages long, but there's an excerpt that I have down here in this presentation on this slide. It begins with the ending cash balance from 2 years ago. From there, we subtract out the prior year supplemental distribution. And then from there, we have to subtract out 15% of the current year's certified distribution after adjustments. So that total amount is listed just above this table that you don't see on the slide, but you would see it on the report. Multiply that by 15%, you'll get that negative $2.438 million amount. But you don't actually have to do that math because it's all done here on the report. But once you subtract that out, you get the excess account balance to be distributed by May 1st pursuant to this code citation. So if this amount is greater than 0, the county will be getting supplemental distribution. Easy as that. Now, of course, things possibly could change. This is where I'm pleading ignorant. But if nothing changes between when this post is posted in February and the amounts that are sent to us by May 1st, this should be a pretty good indicator of if your county is going to get a supplemental distribution or not. Now, this is where the DLGF will calculate that unit level breakdown of this. And it's pretty important to note here that we use the LIT certified report from 2 years ago, that trust account balance year. So if we're talking about the 2024 supplemental LIT that's about to go out next month in May of 2024, then we will be looking at the 2022 LIT report. If you adopted a brand new, let's say, economic development tax in and you started receiving those in 2023, that will have no effect. You won't get any of that for the supplemental distribution. It's all about 2 years ago. All right, so keep that in mind, especially for one of these questions I'll ask you later. And the supplemental report looks just like the normal reports, except it says supplemental, that highlighted above, and the amounts are typically a bit smaller. So, all right, comprehension tests, check. Okay, let's see how well you guys do. You guys are prepared for this whole past hour. You got this. All right, the first question is, my levy increased due to a brand new debt that I issued. Why didn't my lit shares go up? Anybody? You got it. Yes. Both the attributed allocation amount and the allocation amount excludes any debt issued after June 30th, 2005. What's that? You got that from slide 29? You guys are doing great. That's exactly where that comes from. All right, let's take a look at question number 2. This one, there's a bit more to unpack. My property tax levy is roughly the same as last year, but my lit shares really went down. I don't know why. This is scary. Why did this happen? Help me out here. The first thing I would do is I would take a look at the total amount of lit certified shares between this year and last year's. Did that total decrease? Because it could be that your size of the pie stays about the same, but the pie itself just got smaller. Separately, we have people that pay off old debts, but they replace them with a new debt. So regardless of debts being replaced or not, if you pay off a debt that was issued by June 30th, 2005 or beforehand, you will no longer be getting essentially credit for that. That levy that you had for that will no longer be part of that calculation. So that I've seen really reduce people's lit shares amount, their size of the pie. That makes a big difference there. Depending on the size of the debt, of course, though. Another thing we see is sometimes new fire territory comes in, and that causes a spike in the tax rates sometimes, not all the time, but sometimes. If they begin collecting property taxes last year, that would give them a much bigger piece of the pie, and everybody else's slice would get a little bit smaller, maybe a lot of it smaller, right? If somebody passes a new referendum, or there's some other increase in the levy for another unit of government, could be a major bridge fund, could be a cumulative fire fund for a township. But if other people increase their levies by quite a bit, excluding new debt, then that is going to affect people's sizes of their pie. All right, next question, easy one. My certified levy is 0. Well, not necessarily easy, but why am I still receiving a lit distribution? Okay, think back to that page that talked about the allocation amount and the attributed allocation amount. Okay, so there, using my mind, I do not have photograph memory, but I've worked on this presentation a few times. It starts off with the current year certified levy. We subtract out the debt after 2005, then we add in the prior year lit certified shares. So by easy, I mean easy to work through with what we've learned. So because you're always adding back in the prior year certified levy, the prior year lit amounts, that amount would take forever to go down to 0, because you'll always have a prior year certified lit amount. It'll take an incredibly long time, longer than I plan on ever being around, for that to actually drop to 0. Now it'll get less and less every year. Won't be 0. All right. And lastly, last year, my county started receiving payments for economic development lit. I'm now receiving distributions every month this year or last year, but I noticed that my supplemental distribution is wrong. It is missing my brand new economic development. Why is this? And that's because for the supplemental WIT, we always take a look at 2 years ago. So the supplemental distribution is always taking a look at the year we're in now minus 2. If there wasn't a lit type back then, it won't be part of that calculation, right? Now with the resources, I would say your budget field rep is going to be your #1 contact with the department for any budget related questions. We have the budget workshops in July and August. I would absolutely recommend everybody to sign up for, assuming you're a local unit of government. It can be incredibly helpful, and we can really help you avoid some of those common mistakes. And if you've not heard from your field rep yet and you're a brand new local officials, absolutely use this budget field rep app to go and contact them and introduce yourself and ask any questions that you have. Okay. With this, that is 3 o'clock on the dot. I will turn things over to Jenny if there are any other questions or things that she wants to say.
Sure. Thank you, Ryan. Just going to do a couple quick wrap-up items. If you do have any questions, feel free to send those in. You can enter them in the chat box while we are wrapping up, or you can send an email to your field rep, send it to Ryan or myself, and we'll make sure that we get that included. Again, we will be sending out an email later this week that will include the PowerPoint and the PDF version of the presentation, so you will get a copy of those and you'll be able to print those out for reference or save those to your computer. It will also be on, all of the links will be on the DLGF website under the webinar page. So you will be able to download those and share those with other individuals that may have an interest in this topic. We will also have a link to the video. So we'll have the full presentation along with the slides. We will have a survey that we do appreciate any of the feedback. We do review that every month after the webinars. We also take that and look at the feedback that is provided for future topics for when we plan for the next year. So we do appreciate that input and any feedback that you want to provide on the survey. You will also get a link to the survey form. If you're an assessor, you will send that into our office at the DLGF. If you are not an assessor, but another elected official or someone that needs CE credit, it is valid for 1 hour and continuing education credit. You will need to submit that to your governing body or your association, and they will be able to direct you how to record that information so that you can get credit for it. But again, it is 1 hour of CE credit, and that will be all self-reporting. So you will not receive a certificate for completion of the course. You will need to fill out that CE form and submit that to the appropriate group. So we do want to thank you all for joining us today, and we appreciate your time. We hope that we will see you in May when we have another budget topic. Miranda will be giving that presentation, and we look forward to you joining us in May. Thanks so much.